Okay. So a debit spread. We're not talking about credit spreads or anything. We're going to only talk about a debit spread because I feel like credit spreads are kind of just right now in my point of trading. I think credit spreads aren't ideal right now. So we're just going to be learning about debit spreads. So the purpose of a debit spread is kind of like to let small accounts, or not even small accounts, people that don't want to risk that much capital, still an opportunity to get into these trades, right? That's literally the whole purpose. Now, we're used to trading options. So when you're trading debit spreads, the only difference is it's a lower cost. That means what? Do anybody know what that means? If it's a lower cost, then what is the reward? If it costs us lower, because you got to understand is you always got to lose something, right? So there's a lower reward, but there's a benefit to it. And it's a strategy in a way that you can do it to kind of just maximize your reward, but it's a lower cost, right? So a lower cost, lower reward options, you got to understand if you're trading just regular options, you have it's a higher cost, but it's also a higher reward. So that's kind of like the best way to put it on why these are even beneficial. So, for example, we're looking at ExxonMobil. This is a stock that I'm looking to short later on today, just kind of after the Fed's meeting. So I'm about to show you an exact one that I probably will do today, so you can see. And you can use any expiration date that you want to do, but y'all know me, I like to trade weeklies. So we're looking at Exxon. So if we're bearish on Exxon, then we're looking for a put debit spread, right? Oh, also, if you're using Robinhood, you have to upgrade your account to level 2. It's at 2 o'clock. You have to upgrade your account to level 2. I mean, level 3, guys. So normally, most of us, we start at level 2, but then you have to go into your settings and you have to upgrade to level 3. It's literally so simple. You just go in there. It's going to ask you some questions. And it's not even going to ask you no questions. It's going to pop up these little things. And then you can either read it if you want to, or I'm already teaching you it. So you just go on, click continue, and then it'll upgrade you right away. It literally takes like 3 seconds. So we're going to go here. We're going to go to trade Exxon options. All right. So as you can see, Exxon is currently at $95.90. Now, if Exxon is bullish, I mean bearish, I believe that Exxon can go to $92. And I'm telling you this for a reason, right? So to buy a Exxon put, let's go here. We're going to put because I'm bearish on them, right? To buy an Exxon put, it will cost for me. I will buy this 95 one right here. That's the one I like, or the 96, but we're just gonna go with the 95 one. This one that I pick, right? So I want to buy this. It costs $117. It's going to be moving while we're in there, but it costs $117 to buy this. So I'm gonna click this. I'm gonna add it. Now I'm going to sell where I think the stock price is going to. So for me, you don't have to go this far out. You can do literally. You always want to pick a strike below your current price. So if I bought the $95 put, I mean the $95 put, I want to have a strike price that's below the $95. And it's the reason for this, right? Put this in your notes. To keep it simple, right? If I'm buying the $95 strike price for the puts, right? I need to buy something below that. I need to sell something below that, right? So for me, I think that it's going to go to 92. So I'm going to add this right here and boom. So now you see, instead of paying that $126 and then plus that $44, now for this total debit spread, it's only $82. Now, why did this matter? My risk is going to be this $82. My max profit is going to be $219. So that means if Exxon goes to 92 before expiration, or I mean by expiration, I'm going to make $219, right? Now, how do you calculate this? What you would do is you would take, because Robinhood already calculated for you, but some like the other platforms, they don't. So you have to calculate it yourself. It's literally this simple, guys. You take $95. So you take the first strike price that you bought. So you bought the $95 put. You taking $95 and you subtracting it by 92, which is $3, right? So you have $3. You times it by 100 because it's 100, 100 shares or whatever. You times it by 100, and that's $300, right? Now, $300 is pretty much your max. I mean, that's $300 is what you can get out of this in total. Remember, you spent 80 right now. We spend we just going, it's fluctuating right now, but right now we're just gonna say it's $82, right? So you spent $82. You subtract that. and now your total profit is $218, right? Did that make sense? So you're doing, I could put it in the chat. And we're going to go over another example, but you see how it's just a lower cost and it's just a lower risk, right? And then, you know, you're still going to make money as long as it go your way, like a naked, like a regular put or whatever, but that's like your max profit, but it's like a lower cost entry. So this is great for small accounts. So we're going to go over it one more time, right? So let's do a cost scenario. Let's just go back and do a cost scenario. Or let me just repeat this one more time. Then we go to cost. We're going to have to do a couple more of these so you can understand it. So, all right, XOM is currently at $95.45. So I'm going to buy the 95, or you can do 96. You can do whatever one you want, but I would kind of say I want to do the 95, right? That's the one I'll probably pick, you know, the stock price I want to do at the money. So I'm going to get the $95. I'm going to buy the $95 put. I'm going to add it plus here. It costs $130 for me just to buy a regular put. Then I'm going to sell something that I think the stock price is going to. So maybe I don't even want to go $92. Maybe I just think that it can go to $94. So let's just add that one, right? So now this total option is $37 and I can make my max profit at $63. How do you do this? You do 95 minus 94, which is $100, right? 95 minus 94 is $1, right? So it's times 100. That's $100. You paid $37 for it, right? Now you do 100 minus what you paid for it, $37. And then that gives you your 60, whatever, 63, $64 is fluctuating. But do that make sense? So you can 100% return this one, basically. Yeah, 63, 64. It's fluctuating. So, but that's the reason. Now I know it don't probably like some people maybe because we're used to options. So I ain't gonna lie. When I first heard about it and I first started wanting to use this in my swing trading strategy, I wouldn't day trade this. For me personally, I don't feel like it's worth it. I definitely feel like, especially in a market like this, swing trading isn't a bad idea. Using this can definitely be good for small accounts. If the stock price closes below by 95 on expiration, you won't get assigned. You know, if it closed, so if you want the stock price to go to $94 or even lower, that's the only downfall. Like let's say the XOM open up at $93, you're going to make your max profit, but you're not going to make any more than that. You know what I mean? So it's kind of like that's the only downfall about it, but you still get your max profit. That was the whole goal. Our whole goal is to get the max profit in the first place. So yeah, as long as it go there. How do you get level? How do you? Yeah, it's like automatically locking you in profits. Can you? Yes, you can still close out before expiration. Let's say that we get in this today, and then it end up already being up 50%. You know, we can go ahead and sell it earlier. We don't have to wait. How do you get? You go to your settings in Robinhood. It's under. Let me see. And it's the same way on mobile, guys. I'm just showing you on the desktop. You click the little person thing at the bottom, then it's like a little 3, and I circle where it is, but you go to your settings, and then I think it's under investing. Yep, you go to investing, and then it's going to say options trading, and it's going to probably say level 2 for most of you guys, and then it's going to say upgrade, and you just upgrade it. No, you don't have to own any shares. Nope, you don't have to own any shares. Nope. How far? Me personally, like I said, guys, I am a weekly trader, and because I just say I have to know what works for me personally. I know I can't hold a trade long, so for me, you know what I'm saying, I wouldn't probably go that far out, but you can go as far out as you want to. It's like normal options, like kind of the expiration that you'll go out in normal options. For me, I kind of like, you know, doing something like this as far as a weekly. So if you don't like trading weekly, just probably not a bad idea for you then, because it's already a lower risk. It finally gets that weekly risk lower. So it's totally up to you. It's just a little strategy that you can use. But let's go into another example really quick so you can kind of see. So let's go to NVIDIA, right? Keep it simple, guys. This is not hard. Keep it simple, right? We're going to NVIDIA. NVIDIA is currently at 161.94. So we're going to go trade NVIDIA, right? Let's think we're bullish on NVIDIA. So for NVIDIA, We can do instead of paying $600, we can buy the $600 call. We add that here. It costs $600 to buy a regular, right? Now, if we sell it, where do we think NVIDIA is going to? Well, if you want to be, you don't want to be that risky, you can go ahead and do the next. You have to do above. Remember, we're thinking calls now, so you have to do above, right? You have to do above 160. So now what we would do is for me, I'll probably do the 165 for me probably, but if you don't want to, you could do the 162 or whatever, but I'm going to do the 165. So I think the video can go to 165. So now look at that. Now we're only paying $252, right? And our max profit is that 250, right? Now, how do we get the math? So NVIDIA from 160 to 165 is $5, right? That's a $5 difference. You time that by 100, it gives you $500. You subtract what you paid for, so we're just gonna say 250. We paid $250 for it, so your max profit is $250, right? Now, if you don't like the way that sounds, for me, I'm a little riskier than most people that you meet, so I'll probably do the 171. Not gonna lie to you. If the market is pushing, I'll probably do the 171. Gives me a little better, right? I'm paying $417. I might get, $500, $86 in profit, and you can buy more than one. It just depends, guys. It's different ways to do it. You can, if you want to, you can go practice it, go into your accounts and kind of look and see, which ones you like better that gives you the best risk to reward, and go from there. And you guys will see when I'm calling out debit spreads or tell you what debit spreads I'm buying, you will kind of get the idea of like, how am I doing it? I'm only doing these to give me great risk reward, definitely for small account. In this situation for NVIDIA, yeah, it's a little cheaper, but I ain't gonna lie. I probably would just go ahead and buy a regular call and stuff like that. So you got to kind of do it what does for you. But for like Exxon, we were risking, for Exxon, I was risking I'm gonna send y'all a screenshot of the ones that I like, but I'm risking $79 to make $216. So for me, that risk is a little better. So it all just depends. It's like kind of like a risk reward kind of thing. Let me go to Boeing, right? Let's see what Boeing doing. Real quick. So Boeing currently pushing pretty good, right? So if you had did this on Boeing yesterday, you would have been pretty good. I'm mad that I didn't swing Boeing because I actually were bullish on Boeing, but it's all good. I didn't want to swing it to the Fed's meeting anyway. So all right, Boeing is currently at 127, hovering around 128. So if you wanted to, you could buy the 128 call, right? We could buy the 128. I ain't gonna lie, Boeing definitely can go to 130. So we can sell to 130. We have to do above. We're thinking bullish, right? So 130. So this one would be $94 to make a profit of 102. So for me, that risk to reward, it's cool, but it ain't as good as I would like. You know what I mean? So that's the only difference, right? I only like if it's something like that where the risk to reward ain't as good as I would want it, I would probably be better off buying an option. But there are times where, you come on debit spreads, just checking it out, kind of seeing it's really good for if a stock has a lot of room to go. Like if you're buying the bottom of something and it has a lot of more room to the upside, so you can go further out the money to sell those out the money ones, then you can make a lot more. Your profits can be pretty huge. So it just go from there. The wider the spread is, the more profit you make. It's kind of how it works. So like if I do, instead of doing that one, if I think Boeing, if I think we about to have a super big rush, and y'all understand we have times where we do that, but if I think we about to have a super big push or whatever, I come here. It's really this one right here. Let's go right here. Let's do this. Hold on. I'm about to show y'all one that can be a little more better. It's a little more riskier, but it might be a little better on you. So I might do the 130s and I might sell the 135s, right? So it's currently out the money. So I'm playing out the money all the way. So as you can see, if I'm playing further out the money, I'm paying $167. And you see my max profit is a little bigger. So that's all it is. You just got to kind of, play around with them a little bit, see which ones make the most sense to you. Like I said, I've seen people buy Tesla. Like I've seen people buy like Tesla. They bought, Tesla debit spreads for like $30. they bought Tesla debit spreads for like $30 and the max profit was like, $300, right? So Tesla made a big move. There you go. They made a big profit on low risk. So it's different ways to do it, right? But it's just to get you in at lower prices. That's all this is. It's getting you in at lower prices, lower risk, right? Is everything making sense right now? It's not advanced. It's not advanced. It sounds advanced because you're just not getting on, but it's not. So if we're bullish, we sell a call above the share price and buy a call in the money, correct? Let me make sure I answer that right. So if we're bullish, we're buying a call. You can buy it at the strike price. You can buy it in the money if you want to. You can buy the call at any place that you want to do. You can buy the call. So right now, let me just take all of this off real quick. So if we're bullish, so the question was, so if we're bullish, they were asking about basically what do we do? So you can buy, I ain't gonna lie, if you buy at the money or in the money, it's a little better. But if you want to buy out the money, that's fine. But the whole goal is to, I'm normally either gonna buy at the money or a few strike prices up. So Boeing is currently at 128. And if you want to, you could buy the 129 one, right? We're buying a little bit above 29 one. So we're buying above, and then we're selling above that strike price. Does that make sense? Okay, so you just want to, for a call, you want to buy above whatever call that you bought, like any buy that you bought, you want to sell above that strike price to make it, and it's going to make sense in a minute. You want to buy whatever call that you buy, you want to buy, you want to sell above that price if you're bullish. And if you're bearish, you want to whatever put you buy, you want to sell below that strike price, because you want it to go down. Somebody asked, how do we make sure that we get our money? It's pretty much selling the same thing. You're just selling it, right? It's like selling it all at once. So it's the same thing. Just like if you were to sell an option, selling a put or selling a call. Like actually, when I say selling, I mean like just taking your profit. It's the same way. You're just going to take your profit. And I'm going to show y'all an example. I'm going to actually do one later on today if I see one. And I will go ahead and send it in the chat so you can kind of get an idea, win or loss, you can kind of just get an idea on how it looks. Bullish, sell a call above strike price, bearish, sell a call below strike price. Basically, no, you're buying a put and you're selling below the strike price. You're selling a put below the strike price. Just go back to the video and watch it real quick before I let you guys go one more time. Let's say that you're bearish on BA. So you're going to buy a put. So we're going to buy the 128 put. Let's delete that. We're going to buy the 128 put. And if we think Boeing can go to 125, that's a realistic number. We're going to buy the 128 put and we're going to sell the 125 put. And as you can see, it's 115 or 117. Our max profit is 182. So just go back and watch the video and that'll kind of help you. Where will the video? It's on my YouTube. When you get out, when you have your position, it's going to just let you sell it like normal, like let's say you were to buy just a regular put. It's literally the same thing. You're just going to sell it for profit. It's just one thing. It's literally the same. That's why I say I'm going to show you an example when I do one today so you can kind of see, but it's going to sell exactly like a regular call or a put. But all right, guys, I'm gonna let you guys go. I was just showing you now. I know it's kind of hard for you to look at it right now simply because you're so used to, I have a question too. I'm gonna get that. Just because you're used to options where you have unlimited profit. Remember, guys, the whole goal of this is if you're bearish, you can still get in the party. That's literally all it is. So if I'm bearish on BA, but I probably can't afford to buy a regular put, a decent put on BA is $343, but I'm still bearish on it. It just gives me the opportunity to get in the party because I have a smaller account, right? That's all that's the only difference. It just lets me in the party at a lower price, right? So that's all these are for, right? That's literally all it is. Let me answer I have a question real quick. That's one thing I'm gonna do. I'm gonna always help small accounts out. All right, Greg, you can talk now.
Hey, good morning.
Good morning.
Yeah, my question was on like you was just saying right now, I'm looking at Disney right now. So Disney, like you said, if I'm bullish on it and I want to buy, I go to the ask that will fill up real quick and then sell. Let's say if I buy the 96 call and then sell it at, let's say I'm bullish is going to go to 98, then I press that one. That's what you're talking about. I'm on Thinkorswim.
Okay, so yeah, I'm on Robinhood. I'm showing it right now. So you said you're bullish on Disney. Disney is currently at 96. So you're gonna buy just so I can catch you, you're gonna buy the $96 call, right?
Yeah.
And you're gonna sell the $98 call, right?
Yeah.
Okay. So yeah.
Was the difference between the bid and the ask? It's not too much, right?
No, not too much at all. No. And I can't really see because I'm not buying it right now. But yeah, now I'm not gonna lie, on this one, I would probably, if you think it's going to 98, now you have to kind of look and see which one works. So, like, for example, to do this, it's cost $96 and your max profit is going to be 104. So you're risking $96 to make 104. That's pretty much a one-to-one risk reward. But like in this situation, I will look to see if it actually makes sense to do that or just buy a regular call. Now, if I were to buy a regular call on here for 205, and I think it's going to 98, let's look at the Greeks a little bit. For this one, open interest, implied volatility. For this one, if you didn't have it, the $200, then doing it the way that you want to do it is fine. But if you had it, the $200 might be the call probably be a little better to do. But overall, you get what I'm saying? Like, it's like, you're risking $200 here, but in the other situation, you're risking $96 to make basically $100. So it's kind of however you want to put it. You know what I mean? So for me,
that's why I'm trying to understand what you're saying. I'm trying to understand.
Yeah, so it's like me personally, I will probably just stick with just a regular call, right? I would just probably stick with a regular call because I can make a little more. It'll be a little better than a one-to-one risk to reward. But if you didn't have the money, then that's fine, if that makes sense.
Okay, but the ask is just to fill up quicker. That's what you're trying to tell me, right?
Oh, yeah, yeah.
That's what I'm trying to understand.
You're trying to understand the ask. So, yeah, the ask will fill you quicker, right? The goal is to try to
pay more.
You paying I'm not gonna say exactly. Yeah, you paying a little more. Like, you're paying what they want for it. You know what I mean? So it's like they're going to say, okay, well, I want $96, but the bid might be $95, right? So they saying I want 90, or no, let's do it this way. Let's say that the ask is 197, right? So the market is basically saying, or the people that's doing it, they were saying I want $197 for it, and then the bid might be 195. They're saying the lowest I would take is 195, but I'm gonna be honest with you, it's not going to fill that bid as quickly until prices come down to that point, right? So you know what I mean? So it's like, it's not going to fill as quickly. So if you buy the ask, you kind of like, I don't recommend buying the ask, but sometimes you have to buy the ask and sell the bid. That's just kind of
trying to scalp real quick.
If you're scalping, for sure. If you're scalping, for sure, go ahead and, get a nice entry, buy the ask. On stocks like this, that's buying the ask is totally fine. But like, buying the axe on Amazon or Tesla or something like that can really mess you up. So it's pretty much like that. But don't let the axe or the bid price confuse you. Just know your goal is to try to get it a little bit under the axe. And if you can't, sometimes buying the axe is fine. I pretty much just buy the axe on a lot of stuff, especially when I'm scalping. Just, give them the axe and I'm selling the bid. That's just kind of how I do it.
Yeah, because Lawrence says always get it in the money, and I'm thinking I'm making a mistake with that because I do try to get it in the money, but I'm automatically down every time I get in.
So the difference between in the money and out the money is the reason why he's telling you buy in the money is because in the money has intrinsic value, right? And this is another topic for another day. But when you buy in the money, your contracts are already worth something. Technically, when you buy out the money, they're basically not worth anything. So buying in the money, you it costs more, but the risk is less. Like if you buy in the money strike price and the stock pulls back, you're not going to go down that much. But you buy out the money, I ain't gonna lie, out the money can go down 20% real quick. And the reason why is because it has no intrinsic value. So it's already kind of worthless in the point to the market. So the goal for me is I like to buy out the money and let them go in the money. And then I catch that intrinsic value. I catch that IV spike. So it's different ways to do it, different strategies. But like if you're a person, I definitely, in this type of market, in the money is kind of the way to go. Just because these pullbacks hurt and everybody can't, afford to lose as much money. So I will in the money definitely works. I go in the money, sometimes I'm really a at the money person. So I buy out the money, but it's very close to the strike price. So like, for example, Disney is at, $96. The highest I go is like that next whole number at 97. That's kind of how I do it.
Yeah, because that's what I see that there's no half. There's whole numbers. Right now it's at 96.43. If you want to buy a call, because you see it like if it's bullish, then you buy that 96 call, which is 203 right now that I'm looking at because the numbers are changing. Mm-hmm. And you want to sell it at 98, like we was talking before. That's the way I was doing it, but I don't know if I was doing it correctly.
No, you're doing it right. No, you're totally fine. You're doing it right.
It's the same thing, just the opposite with puts, right?
Yep, same thing, just the opposite with puts.
Yeah, because I don't understand why if a certain stock is down. See, I have puts from yesterday. I got Apple puts from yesterday, and I see that, it's ranging right now, but it's the one I bought it at 134, but I'm down.
So if you bought it at which one? You bought a regular option?
Yeah, yesterday.
So you bought a regular option. Apple is currently at.
I was holding it just, to see how the market reacted this morning.
Yeah, so Apple is up on the day. So when you bought a put, right? Or you bought a call?
Yeah.
Oh, you bought a put.
I bought a put.
So yeah, Apple is up. Apple is up, and right now it's kind of just ranging. So what's happening is you're losing premium. Whenever a stock, that's one thing that kills options is when we have these ranging markets to where like the stock price is just going up, down, up, down, up, down, up, down. So that starts to cause us to start losing premium. Even if the stock price has started to come down, these like pullbacks and everything is causing you to lose premium, right? And that's the problem. And also the IV on the puts were pretty high. Which option that you're in again? Which one was it?
134. 135.
35.
Yeah. I know the answer already. I should have cut it. But I was holding it just because I was like thinking, okay, the market might go down a little, and then I'll cut it off.
And it could. Actually, this is not a bad contract. You actually did really good. This is not a bad contract at all. It's low IV. Just the market is just ranging right now, so it's just losing premium. But this actually is not a bad contract.
So that's what I was gonna ask you the other day. When you try to do a trade like this on a day and you ended up holding it for another day or two, whatever, even though we put time on the contract for it, because I got a July 8th put at 135. Do you think it's still, I think it's not good because I'm thinking of making money the same day. But sometimes I'm thinking, and if I hold it for a couple of days, even though it's down, I see Apple coming back down to 130. Do you think that's a good idea to hold that contract?
So yeah, if the reason, so why did you get in Apple? So is the reason why you got in just because of you?
The reason I did is because I know with the classes I've been in, everything, we all talked about this, and we see Apple coming back to 130. So I that's why I put that put to 135.
Okay. So me personally, you did one thing that I don't do, which is a good thing. You bought time. So if you bought the 135 put at for July 8th, you have time. Apple is ranging right now. It's currently, it's not, messing you up too bad right now. I will probably still hold it, me personally. If the market does run up and Apple still looks bearish, then I will buy another one maybe to like lower my average down a little bit. But overall, it's not a bad contract. The market still, the move that you're waiting for hasn't happened. Yeah, it sucks because you wanted to make that money right away. But in this situation, I do believe that if the market starts to fall, I do believe Apple can go to 130. I definitely agree with that. But like you're not in a bad situation if that makes sense. Like you're good. How much are you down, like percentage wise?
Um, it says right now for the day, I'm down 18%.
So yeah, it's right now it's ranging. Like it kind of sucks because the only thing that sucks is really the entry. You could have probably entered that a little better, probably waited for a little later today to do that. But overall, it's still the setup is still there that you're trying to get. Apple is still bearish long term. So if for me personally, if you're okay with holding, I definitely will hold and just monitor it. You know what I mean? I would definitely still hold. You bought time, so it definitely can. You can get all your money back. Actually, this play still can go 100% return if that's what you're looking for, even if you're down 18% right now.
Yeah, even though I'm new, this is like I guess this is what I'm fighting between scalping and swing trades, you know.
Yeah. So
I'm still new, so I guess that's why I'm having the issue of I want to make the money right now, but if I give it more time,